Can I just comment quickly on the stock market stuff? I actually agree with Josh that things are probably priced to perfection now on the stock market. But to your point about things like structured credit, we're still pricing an apocalypse there. So it's probably somewhere in between those two, which implies that the credit markets are going to do pretty well over the next 3 months as those spreads start to tighten to something a little bit more normal, not an apocalypse spread pricing, but again, not a full recovery, but something better than where we are right now.
Can you comment specifically, Anthony, for us on this structured credit trade, or that wasn't especially kind to you guys in March? I mean, that's sure. The Journal story. I know you've seen it. That's the Journal story that said you guys had a terrible month of March.
I've seen it.
Down more than 20% in your main fund because of that.
Yep, we were down 22.5%. We liked getting that information out early. I guess the good news about that article, it was very accurate, but we got ahead of it to our clients. But I think that if people really understand what's going on in the structured credit market, if you have unrealized losses in your portfolio and those bonds are still going to perform, granted, there may be some more defaults, but you've got a lot of coverage there. You've got agency coverage from Fannie and Freddie. You have mortgage servicing coverage. And I think if you step back and you look at what happened, they changed the capital requirements on the repo desks around the nation's banks, and that caused a cascade of selling of the mortgage REITs and many people in structured credit. Some guys were down 40 to 70%, and in one case, a mortgage REIT went to zero. So it was a very painful thing for structured credit, a global pandemic, because it sparks the fear, Scott, that people are going to default on their mortgages. But I want people to step back. It's sort of like a George Bailey moment in It's a Wonderful Life. The pain is already in the marketplace. We're sort of priced for 15 to 20% defaults. That didn't happen in 2008. And despite what people are talking about right now, it's not going to happen this time. You've got $12 trillion coming into the market from the government, about $6 trillion if you really study the fiscal stimulus. And of course, the Fed is now up to $6.3 trillion. And just the reason why the market's doing well, you've injected $1.4 trillion of balance sheet capital from the Federal Reserve over the last 4 weeks. So they're moving at about a 14.5 times faster clip to repair the markets this time than they did in 2008. And so for those reasons, somebody that studies this stuff, if you look at historical spreads, if they just tighten a little, you'll see a real spring in those securities. So I'm really cautioning people to hold the line here. Do not sell in a pandemic, because what happens is you get out on the bid side, and the bids are very, very sloppy. And when the market firms up, you'll be regretting those sales.
So I just want to make sure people understand what your business does. We talk about fund of funds all the time, and the audience of people watching now is great because people are working from home. You essentially take money from investors, you pool it, so to speak, and then you allocate it out to hedge funds. You give people who may otherwise not have access to a hedge fund manager the ability to invest in the hedge fund by virtue of pooling the assets and then investing it. Have I described that correctly?
Yeah, that's correct. It's basically it's a hedge fund vehicle for the mass affluent. Our minimums are between 25 and 50,000. We've been doing this for 15 years. We had one bad year, which was in 2008, where the fund was down about 19%. But we rocketed out of that with a 21% and a 17% return in 9 and 10. And so if you look at our 15-year continuum and you just measure it over a market cycle, the product has actually done very well, and it's usually acted as a buffer from other things in the portfolio. This particular instance, a global pandemic, unfortunately, that struck right at the heart of what we're doing. SkyBridge has a tendency to be very thematic, and we were in structured credit, frankly, because mortgages are the heartbeat of America, Scott, or at least one of the major heartbeats of America. As Dr. Bernanke said after the last crisis, we need a free-flowing origination market for mortgages and a secondary market, which is why the Fed is always in there providing a backstop. Remember, 60% of the small businesses in America, 31 million small businesses, 60% are tied to housing. And so for these reasons, the Fed is offering that buffer, and you're seeing a big injection of capital right now. But yes, that's That's basically what we do. But because we're thematic and, frankly, we were cautious on the market, we were in these sort of cash flow generative strategies. They're still flowing the cash, but unfortunately, because we're subjected to mark-to-market rules and so forth, we had to position mark ourselves very strictly to where we are right now.
The Journal says that you have tried to withdraw your money from some of the funds that you were invested in and haven't been able to. Can you comment on that?
Okay, so that's the part of the Journal article that was actually inaccurate. In the case of EJF, which is mentioned in the article, these guys are brilliant investors, Scott. Manny Friedman has been in the industry for 50 years. We actually love his portfolio. We actually went to Manny Friedman and asked him to suspend, because what we don't want him to do is, let's say he had $1 of assets on March 15th and that dollar went to 85 cents. And if he gets overwhelmed with sells right here, we don't want him to sell something that we think is worth $1 for 60 cents, getting flushed out in a crisis. And so the opposite is actually true in that case. We did not ask for a redemption there. We actually want to cooperate with him, and we thought it was best for him in the interest of our shareholders and those securities to gate or suspend that fund. And so that was a slight nuanced thing wrong in the Journal article. You know, Greg Zuckerman is a very good reporter. He got that thing pretty much 100% accurate.
Okay. What about SkyBridge? Are you
as painful as it was? I'm sorry?
Are you having to deal with redemptions yourself? I mean, give us a gauge of what you're hearing also about the hedge fund world.
Well, listen, I mean, the thing I'm the most proud of is the SkyBridge sales force. We've been working 14 hours a day over the last 4 weeks, and I think we've gotten to 95% of our investors. I'm very proud to say that our redemption totals, and our window, frankly, closed today, our redemption totals are quite low. They're slightly above what we would typically get in a normalized year. And so that's sending a message to people. There's experienced investors in our fund, and those investors know that they shouldn't be selling at a distressed price right now. A lot of this stuff is spring-loaded for success going forward. Additionally, as surprising as this is, we are writing tickets into that fund. The principals like myself are adding money, and we've got very seasoned people that are looking at this fund as a huge distressed buying opportunity. And to what Josh was saying, if you think the equity markets are priced for perfection here, the bond markets are lagging the equity markets. And as we know, 31 years in this business, that doesn't last forever. Warren Buffett always says the markets are a voting machine in the short term. People have voted panic. But they're a weighing machine over long periods of time, and they will weigh the fundamentals on very good, secure cash flows, and we'll see that appreciation going forward.
You say the equity market's priced for perfection, Anthony. When you look at what's happened in the stock market, where we're trading today, we're Dow 24,000 earlier today.
Yeah.
Does that make sense to you compared to what's happening on the main street that you talk about so often?
Well, I'm in Mike Wilson's camp on this thing, that I really do think we did get to the low. I know some of the traders on Fast Money were talking that we may retest it. I'm not a seer, so I don't know the answer to that. But it just felt like on March 23rd, when the VIX went from like 85 to 44, literally a 50% haircut in the VIX, that felt like full-blown capitulation, Scott, like we saw in March of 2009. Are we overshooting here in the short term? Perhaps. People are anxious to get out of their homes. I sort of am very bullish, because when I look at the magnitude of stimulus, I think it's very, very hard to put down the American economy with $12+ trillion of stimulus going in. The SkyBridge economic team estimated that the lost output, which is basically a 65% shutdown of the economy, is about $3.7 trillion. You are overwhelming that with a green water wall of money from the federal government. And so I wouldn't bet against that. That aphorism about not fighting the Fed, we may be getting a little ahead of ourselves in the stock market, but the bond market clearly is lagging, and I think that's where the opportunity is.
Let me open it up. Josh, you want to respond or comment on that point?
Yeah. First of all, Anthony, it's good to see you. I hope you're sheltering in place, someplace safe.
Yeah.
I want to push back a little bit and see what your take would be on this.
Sure.
First, it's possible that we saw capitulation in panic terms with a VIX at 90 in mid-March. but it's also possible that we revisit those lows at a lower VIX, meaning it's less panic, more despair, which would actually be the 2008 experience. So you had a panic low after Lehman and AIG in September and October. We did not get that scared again in VIX terms, but we ended up much lower 6 months later, and that's despite a then record amount of stimulus. Keep in mind, TARP was in the fall of '08. We didn't bottom until the spring of '09. So I think both things can be true. The government has gone to extraordinary lengths to put money into the economy, liquidity, stimulus, whatever you want to call it. And we may have seen the worst of the panic side, but that doesn't mean we can't see worse in terms of price much later, despite all that stimulus and a lower VIX the next time we get down to those levels.
So listen, like I said, I'm not a fortune teller. You're more experienced on the equity side than me. We've primarily focused on fixed income. I remember those days. I remember that March 9th low in 2009. And so that, in fact, could happen. But I think the broader point that I'm trying to make, Josh, right here on a relative basis, just give you that example. 2009, the first quarter, U.S. markets were down 10% to get to that low. But the bond market was actually rallying. The bond market was probably, our stuff was up about 3 when that stuff was down 10. And the bond market was probably up 2.5, 3 during that period of time. So I accept your point. Nobody can predict what's going to happen. But I think if you just step back and you look at the macros, with $12 trillion coming in to overwhelm the $3.7 trillion of lost output, I think we've got a fighting chance. One last quick point. This is sort of like a national hurricane. 50 states, everybody's got knocked into their homes. There's been a 9 to 12-week work stoppage. But the very, very good news is when we go to leave our homes, the homes are intact, the water infrastructure is there, the electrical grid is there. You guys were commenting earlier in the show about the banks. They're in pretty good shape. Maybe they have to take a little bit of loss reserves, but it's nowhere like 2008 when the banks were in negative equity. Last thing, no villains this time. This is enabling the Fed and the policymakers and the House and Senate to respond overwhelmingly with very, very big fiscal stimulus. Remember the book Firefighting from 2 years ago, where Geithner, Bernanke, and Paulson said they wish they could have moved more quickly, but they had a lot of villains in there and a lot of policy people didn't want to reward bad banking behavior. There's nobody here that we can point the blame to. It's an invisible microbe that declared war on the U.S. economy, and I like the fighting chances of the U.S. economy and particularly fixed income in the securities that we own.
You look, I take your point. But there is and I don't know if you yet want to call it a movement. There is talk, certainly, Anthony, on social media at the very least, and even to some extent on this program in the last week or so, about this great disconnect of the stock market and Main Street. So there may not be an individual villain or a group of, to use your word, villains, like some viewed the banks in '08. But there are a lot of people who have an issue, including smart people, some billionaires. Chamath Palihapitiya was on our show last week making this point, and his point ended up getting 10 million views on Twitter, by the way, that Wall Street is getting bailed out and Main Street, and this is a collective Wall Street is getting bailed out right now, while Main Street is scrounging for food to eat tonight.
Well, listen, I watched that interview last week with the social capital guy, Scott, and he made a lot of very valid points. One of the problems that we all have is that we have to deal with the world the way it is, and unfortunately, we can't have a normative world and deal with the world the way it should be. We can make the argument that monetary policy in some ways has furthered that wealth divide because people that own the assets, if you have interest rates going lower, everybody on this show knows interest rates are the physical gravity of financial assets. So people that own the assets, they're feeling the wealth effect, and the other people are being left behind. So I agree with him on that. I think we need other types of policy response. Is it a reengineering of the K through 12 public education system? Is it infrastructure? Is it jobs training? I think we need to ask our public servants to take some very hard steps here to use tax and social policy and government spending or at least government incentives to try to flatten that gap. I'm not disagreeing with what was being said. And certainly, if the Fed is pumping $6 trillion into the marketplace, taking interest rates to zero, a $4 trillion quantitative easing program, it's going to show up in the markets. You know, one of the things our managers did, they took off a lot of their shorts right now because the TALF program is actually buying the stuff that we were using as a hedge. So I accept what the social capital gentleman was saying. I think it's a broader discussion point. We don't want to go into the next decade looking back on what happened here and said, man, the rich got way, way richer and the poor struggled more. I think that's going to be a setup for more nationalism and more populism that none of us want.
The risk is, you know, here we are, you know, to use numbers, we're talking Dow 24,000 at the same time where the $349 billion runs out. And now we're back to this grappling on Capitol Hill to try and get money to the people who need it literally tonight. So that's the point there. And by the way, of the PPP, there are some reports out there that some hedge funds are applying for those PPP rescue funds. I don't know if you've seen those reports or not. I'm wondering what you make of that, if in fact it's true. And I'm just curious, in fact, if you have as well, given the size of your firm.
Yeah, so, I mean, here's what I would say on that, and I've been very consistent on this as well. I don't think we should be discriminating against anybody. And so I got in trouble on Stephanie Rule's show last week saying that hedge funds should apply for it. My team has looked at it. I don't know if we got ahead of that window or not, but if you're asking me would I apply for it, I would, because I think it's a responsible thing to do as the managing partner of SkyBridge to protect my employees. And I know my investors would look at me and say, of course, he's got to be fiscally prudent and apply for it. Justice Learned Hand once said in a famous tax case that anything that's available to you from the government, you have the legal right and you should take advantage of it. And so as a fiduciary, and particularly somebody that cares about my employees, and SkyBridge pays 100% of our health insurance, we do the maximum allowable for retirement and so forth in terms of profit sharing. And listen, you know, we serve free lunch at SkyBridge every day as well. So for all those reasons, I want to protect them. I just don't know if we got to the window on time, but I would apply for it. And if people are upset with me for that, what I would say is, you know, Goldman Sachs got 10 or so billion dollars from TARP. There were certain commercial banks that got $25 billion. I don't see why we need to be discriminating and have this sort of class envy and this sort of ridicule. I would just do, and I would recommend to everybody listening, do what you think is the most prudent thing to do for your staff. But I do predict that extra $250 billion, Scott, that they're talking about will get unleashed into the small business community. And I do think that that will provide a big bump. You know, I own a restaurant called the Hunt and Fish Club with a group of partners. They did apply, and they're getting 8 or so weeks of payroll and money to foot their expenses. They'll be able to open that restaurant and save all those middle-class jobs. So for those reasons, I think that window's open, and people that are able to take advantage of it should.